everybody. Welcome to an investor's guide to understanding the Federal Reserve. You hear about it every single day in the media, but what exactly is it? Here to help me understand it all, we have Bill Addiss, a financial industry expert. Bill, welcome.
Thanks for being.
Tell me a little bit about the Federal Reserve from a layman's perspective. You know, we hear about it on the media all the time, and we know maybe some of the impact. But I'd like to know how this all came to be and what it means for us.
Great question. Yeah, few individuals understand the Federal Reserve as we have it today. And the Fed as we know it today is actually our third effort at a central bank. The first Fed, thanks to the movie and the book, many people are aware that Alexander Hamilton founded the first Fed back in the 1700s. The Fed as we know it today is our third effort at a central bank and was created with the Federal Reserve Act of 1913, so it goes back to that period.
So it's our third. Did the first two times just fail miserably? I mean,
they didn't address the growing needs of the banking industry, let's put it that way.
All right, and as I think we're going to learn, it really is all about the banks here. So structurally, how is the Fed built in the U.S.?
What most people don't understand is the Federal Reserve is not a part of our government.
Oh, okay.
The Federal Reserve is actually a corporation. There are shareholders in the Fed. There is stock in the Federal Reserve. It's not a part of the government. It is a corporate structure. In fact, Federal Reserve stock actually pays a nice 6% dividend. It's a corporate structure, not a part of the central government, unlike most other sovereignties where it is a part of the central government.
Seems a bit misleading. Because everyone thinks it's the Fed. It's a federal thing, but it's not.
And even more disconcerting is there's not one Fed. There's actually 12 separate Federal Reserve banks here in the U.S.
Okay.
When the system was set up back in 1913, they broke the country up into 12 geographic areas, and there's actually a separate Federal Reserve for each of those 12 geographic areas.
Which I think probably makes sense, because then you get a better understanding of each geographic area. For example, the economy in Minnesota is probably not as robust as California,
Exactly.
So let's break it up a little bit.
Exactly.
Okay. All right, so we go from those 12 different districts. Now, how is the supervision here done by the Fed?
Well, when the Fed was created, it was actually given three distinct responsibilities. Responsibility number one is to supervise the federally chartered banks in its area.
Okay.
So Citibank is supervised by Fed New York. Mm-hmm. So the Fed has supervisory authority over banks, which I should point out, the banks are the owners of the Fed. When I said there's stock in the Federal Reserve, that stock is owned by those banks.
This almost sounds like the inmates running the prison. I don't want to be a conspiracy theorist.
Many people would not disagree with that analogy.
All
Absolutely. Right. So the Fed supervises its owners. That's responsibility number one. The Fed also is responsible for conducting our monetary policy. We'll get into that in some detail. And then the third responsibility is to facilitate the transfer of cash. So, for example, the wiring system of moving money from bank to bank, the creation of money is the responsibility of the Fed.
So they want to know how much is out there, where it's coming from, and if you're sending it to people and they're receiving it, they want to know who's getting it.
Exactly, and they actually facilitate that transfer. The Fed owns the wire system to move money back and forth.
Wow, interesting. Now, you mentioned something about the chartered banks. It's just for my own understanding here. When I think of federally chartered banks, I think the Fed kind of oversees everything. So the School First Credit Union, are they kind of governing that one too?
Great question. No, what we're talking about here in terms of supervisory responsibility are what are called federally chartered commercial banks. So think of it like the big names.
All right.
Now,
so our too big to fail ones.
Exactly.
Okay.
Perfect. Again, going back to that conflict of interest you alluded to.
Yeah.
So we're not talking about savings and loans here.
Okay.
We're not talking about credit unions. But when we talk about federally chartered commercial banks, there are almost over 8,000 of them here in the U.S. So it's a huge responsibility.
Right. Well, when I hear about all this stuff on the Fed, generally there's the Fed president and the chairman is going to be doing all these presentations. But I always hear about these different regional guys speaking. How many different bankers are there in the FOMC?
Well, that's when we talk about the monetary policy aspect of the Fed. That's actually been delegated to a committee you just made reference to called the Federal Open Market Committee.
Okay.
This is the committee where the power lies in terms of monetary policy here in the U.S. Now, the FOMC as a committee is made up of two separate and distinct groups. Now, each regional Fed, all 12 of them, elect a federal president.
Okay.
There's a president of the Fed elected from the local banking community.
Right.
Now, what we do is we take 5 of those 12 presidents and we put them on this committee called the FOMC. And exactly as you said, they're there to represent their regional constituencies.
All right, so let me get my math right here. I got 12 kind of federal banks.
Good.
On a rotating basis, we'll figure out maybe how that works, but 5 of those 12 are now on the FOMC.
Correct.
Okay, and is this a permanent thing? Is it like, hey, you won the lottery, or is it rotate? 4-year terms.
4-year terms on a rotating basis. Great question. Then on top of that, this committee is actually a 12-person committee. Now, the other 7 members of this committee are called the Board of Governors, and they have national interests, whereas the regional presidents are there to represent their regional constituencies. Right. The Board of Governors are there to represent kind of the national interests. And this is where we do get some politics come into the process, because the president appoints those 7 members. They're appointed by the president, confirmed by Congress.
Now, if a president comes in and appoints all 7 of these board of governors, you could have an extremely biased board of governors. I mean, we hear about the Senate and being one side or the other. I mean, to me, this is an incredibly powerful office or position that could be completely manipulated.
And you can make the argument these are 12 of the most powerful people in the world because they're
Absolutely.
setting monetary policy. The way that the system has been structured to try and avoid that is as a board of governor member, you serve a 14-year term.
Okay.
So the idea is no one president is stacking the deck.
Spreading it out
and
a
they're
little bit.
spreading it out a little
Okay,
bit.
good.
So
good.
right now we're dealing with appointees from many past administrations.
That does appease my conspiracy theorist heart here.
Good.
Okay, so we've got 5 regional presidents on that board. You also have board of governors, which has 7 who are outside and are nominated by the president. They don't have to be involved with finance. They could be involved in banking. They could be involved in healthcare, but they just have to have the president's perception they're going to do good at oversight.
Exactly right. They come from academia. They can honestly come from political contributions. They can come based on industry background.
Okay.
But within that 7 members called the Board of Governors, the president also appoints the chairperson of this committee. Okay. And this is where I think our press does an injustice. They talk about a chairman of the Fed or a chairperson of the Fed. There's not. There's a chairperson of this committee.
Right.
And as a chairperson, they serve a 4-year term. So for example, going back to Ben Bernanke, he was a board of governors, served a 14-year term. He was appointed to 3 separate consecutive chairmanships, 12 years, and then when he didn't get reappointed, he decided, I don't want to be on the committee.
Well, I'd take a step down and just be the cashier again. I was the branch manager.
Right.
Got it. All right. What are some of the tools that the Fed can use to help stimulate, control the economy?
And this is where we get into the weeds a little bit, because the Fed, FOMC, is responsible for monetary policy here in the U.S. So the way they use as their primary tool is what is called the manipulation of the Fed funds rate.
They even use the word manipulation.
They do.
Okay, that's good. I didn't want to use that word. I felt it was a bit too much. Okay, good.
That's the term. So to explain, we have an incredibly efficient banking system here in the U.S. We have the Fed funds rate is the rate that banks borrow money from each other.
Okay.
This is called the interbank rate. In London, it's referred to as the LIBOR rate. It's the same thing. And the Fed actually controls and manipulates that interest rate. So the manipulation of the Fed funds rate is the primary tool they use to either stimulate or slow up, in some cases, the economy.
So let me ask you a quick question. If the Fed funds rate is what a bank is loaning another bank,
good.
Look, I'm a bank. I'm prosperous. I'm doing well. Why do I need money from?
Great question. The way the system works is federally chartered banks here in the U.S. have to keep a certain percentage of their deposits on deposit at the Fed. It's called the reserve requirement.
Right.
And that number can change every day. So for example, if Citibank tonight has more deposits than withdrawals, that means tonight Citibank has to put more money on deposit at the Fed.
Got it.
Conversely, if B of A has more withdrawals, that means they have too much money at the Fed.
Gotta pull some out.
So every night, these 8,000 banks are settling up with the Fed. And those banks who need money, deposits, will borrow it from those banks who have it. And the rate at which they're doing this borrowing is the Fed funds rate. So if the Fed brings this rate down, they're basically saying to the banks, it's cheaper and easier for you to borrow money. Hopefully that should act as an economic stimulus. Exactly. And conversely, if they want to slow up the economy, they're going to raise that rate.
So from 2009 to 2016-ish, we had a period of very, 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 very low rates, near zero.
Correct.
So that Fed funds rate being zero, that was really designed to say, let's stimulate the economy, let's get the banks out there lending, and we could argue whether that's worked or not. Right. Now we're seeing raising interest rate environments, so now they're saying let's maybe slow things down a little bit.
Exactly, and through this manipulation of the Fed funds rate, that's the primary tool they have. Now I should also point out the Fed is also the lender of last resort. If a bank has trouble, they can get it from the Fed.
I love it. If you're really failing, we'll help you out.
Exactly.
And I guess it's systemically you need to have a lender of last resort. I mean, I know we would all look at it and make jokes at the Fed, these banks shouldn't have it, but they probably should from a systemic failure.
We want to have a security of our banking system.
Right.
The way we get that is the Fed is the lender of last resort. And when the banks borrow from the Fed, that's called the discount rate.
Okay.
And that also is a rate that they can manipulate to try and affect the economy.
Now, some of the other things we hear about the Fed all the time, especially in the last 10 years or so, have been this phrase that all of a sudden came out of nowhere and became very, very popular, quantitative easing. It sounds almost like a romantic comedy, but what is quantitative easing and how did the Fed utilize this tool to quote unquote help us out?
This is where we're in an untested economic experiment. Truly.
Nice.
Under Ben Bernanke.
Guinea pigs.
We are, absolutely. Global guinea pigs. Under quantitative easing with Ben Bernanke, and he was the gentleman who was credited with bringing a theory to reality. What our central bank did is they literally created In a 5-year period, they created $2 trillion of new cash.
Wow.
Literally created new cash. And with that new cash, they went into the marketplace to buy treasury bonds. So if you think about it, by being a buyer of bonds with new money, that's injecting more liquidity and more cash into the US economy. And our Fed did 3 rounds of quantitative easing for a total of over $2 trillion of new money that they injected into the economy to try and act as a stimulus.
And then apparently the Fed went out and partied with Chubby Checker and did Operation Twist.
Well, Twist is another twist, very good. And what they did under Twist is with this $2 trillion worth of treasuries that they own, they're constantly adjusting the maturities of what treasuries they want to own, short-term or long-term, to try and affect those interest rates. So things like quantitative easing and Twist were economic concepts for years.
Right.
But Ben Bernanke was really credited as being the central banker who put it into practice.
You know, as an American, it kind of scares me a little bit because, you know, you hear about quantitative easing and 1, 2, 3, Operation Twist, and I'd like to think that the optimist in me says it was a good thing, it's there to help the economy. But I can't help but to look at a country like Japan, who has been doing quantitative easing for the better part of 20 plus years, and I don't see them in a really better place.
The problem is, how do you prove a negative? How do you say what would happen if these economies hadn't done these economic maneuvers?
Right. What if?
What if? But you're right, and we've seen many other countries do it. After the Brexit vote, literally within 48 hours of the Brexit vote, the British the Central Bank of England said, let's do quantitative easing.
It's worked so far for them.
European Central Bank has now done $2 trillion of quantitative easing. Japan, we unfortunately call it printing our way to the bottom.
Right.
We're printing up currency in an effort to try and act as an economic stimulation, but we also have to acknowledge the impact to our currencies as a result.
Yeah, and it's been significant.
When you're printing currency, you are devaluing your currency. That's what's been going on.
Which some would argue is one of their powers, but you know, as someone who is a holder of U.S. denominated assets, I'd like to see my currency getting stronger.
Right.
All right, so I always watch these press conferences and watch the Fed chairman out there doing her FOMC statements. What are some of the things that the Fed is also kind of known for doing with regards to dissemination of information?
Our Fed has incredible flexibility as to how much and what type of information they want to release. And this has changed dramatically over the last couple of years until we are at a point today, unlike past, where we are seeing unprecedented economic projections. The Fed will tell us what they expect to be doing in the future. This is all targets as to where they want to go, which is why I say anybody who's involved in the marketplace, you're remiss if you aren't keeping track of what the Fed is looking at in terms of what they're going to be doing, because they give us projections now.
Now, as we established from the opening segment here, I'm a bit of a skeptic. For me, how much can I trust these statements? I know that's extremely subjective, but this is a lot of power, and I can't imagine the central bank coming out and saying, wow, we are in an absolutely horrible spot, our economy is going to collapse tomorrow. They're always going to have a little rosier, rose-colored glasses here. I don't know what I trust.
Absolutely, and the targets can constantly be changing.
Yeah.
You know, what the Fed will announce as a target 1 month could be very different from 6 months from now. So the fact that the targets are always moving does give them a fair degree of latitude. You're absolutely right.
All right. Let's go to another topic, which, again, kind of ties into that, which is transparency.
Yeah.
In my young lifespan watching the Fed, it seems to me that there has been a greater tendency towards transparency. And maybe you can walk us through some of the new, I guess, not initiatives, but new ways that the Fed is becoming transparent.
And this is where we've seen huge flexibility based on the personality, quite frankly, and the philosophies of the Fed chairperson.
Right.
They hold incredible power in terms of how that FOMC committee operates. Even though they're only one of 12 votes, they hold a lot of sway. So, for example, I first came into the market under the administration of Paul Volcker. And this was back during the Jimmy Carter administration. We had high inflation, the first oil crisis. And under the Volcker Fed administration, we had no transparency to the Fed at all.
Just, here you go. That's what's happening.
The Fed would meet, as they do now, 8 times a year. The FOMC would meet 8 times a year. And they would make a decision as to what they were going to do with interest rates, and they wouldn't tell us what they decided. Literally, the committee would disband, they'd go leave, and it would sometimes take us days or weeks to figure out, what did the Fed do? Did they raise rates? Did they lower? How much? How little?
Yeah.
There was no transparency to the Fed whatsoever under the Volcker administration, by design.
Yeah.
Yep.
Which seems a bit scary to me. I mean, I guess I'm in the era now that's more used to that level of transparency. So Paul Volcker out there, like, secretive, under the polar ice caps in a submarine making decisions, kind of secrecy. We've since softened that a little bit. Walk us through. So after Volcker, who do we go to?
Well, then we get into the Alan Greenspan era.
Ah, yes.
And this is where we start getting the idea of some transparency to the Fed that we've become used to now.
Right.
But under Greenspan, who by the way was mentored by Ayn Rand, is his mentor, the degree of the empowerment of the individual, information. And under the Greenspan administration, what we saw is that door opening up to transparency. So for example, under Greenspan, when the FOMC would meet 8 times a year, they would literally give us a press announcement as to what their decision was. So now we got some insights.
Right.
They also even went to the point of releasing the minutes of the meeting 30 days later. So we could actually see the dialogue, we could interpret the adjectives and the nouns.
He said maybe as opposed to should.
And we microanalyze that.
We do.
And we get the notes as the opportunity to do that. So all of that was introduced under the Alan Greenspan era.
And I think that Greenspan took it a little too far, because I remember on the old trading floor days when I was a really active trader, the Greenspan briefcase camp. And he would literally walk across the street and they'd see all the papers sticking out and people would be like, oh, he's got a lot to talk about today. I found that rather humorous. You take transparency to a whole nother level there. After Greenspan, who did we run into? We went Bernanke, right?
Then we come on to the Bernanke administration. And Bernanke expanded that transparency even more. Because under the Bernanke administration, not only would the Fed hold an announcement the day that they met, they would also hold a press conference where we could literally ask questions of what they were doing. The financial press could do a Q&A, and that once again gave us even greater transparency into what they were doing. We could get a dialogue with the Fed. That was
it's a great soap opera for those of us who love to. You can watch some of those, and the grilling that some of these congressmen have put on them and senators. It's fantastic.
Absolutely.
All right, so we will go from, it seems, I'm seeing this trend now of getting more and more transparent. Janet Yellen, as I've seen, she seems to be pretty transparent as well.
Again, she's expanding that umbrella even further. Because now, under the Yellen administration, what we have seen under Yellen is that not only does the Fed tell us this is what our posture is, this is what we're doing, now they're making projections into the future as to what to expect. Are we looking for rate hikes? What factors are affecting that decision? What should you be looking for further rate hikes down the road? So we're even now getting economic projections from the Fed. Unprecedented.
So what's next? Are we gonna have webcams inside the FOMC, not just the meetings, but at the table meetings? I mean, it's getting more and more transparent.
Yes, but I do have to agree with something you said earlier. We're always a little bit skeptical.
Yeah.
Because sometimes what you see is different than what you feel. And that's why we investigate the nuances of every adjective and every adverb during these press conferences.
Just like a good magician, they always show you what's in one hand, full transparency, but they're doing something over here. So what's great about the Fed, guys, is you see it's got a long-standing history. We're on the third attempt, which released in 1913, has been so far, I'm not going to say a success, but it's been working, right? The Fed has been doing okay. It's becoming much more transparent. And I think as investors, we should all pay close attention. Whether you believe the statements or not, that's for you to decide. But the information is displayed for you. And remember, this is the information that's going to steer our economy as a whole. It's incredibly powerful stuff. So the more you know about it, the better off you're going to be and more aware you will be of some of these changes. We're going to look deeper into maybe some of these financial topics and other lessons at otacademy.com.